Today, between the devil and the deep blue sea. Hi again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. Well, as you know, the central banks around the world have been lifting rates significantly to try and tackle inflation. But now the question is recession, because the drumbeat of recession grew louder after the US economy shrank for a second straight quarter as decade-high inflation undercut consumer spending and Federal Reserve interest rate hikes stymied businesses and housing. And yet, US stocks on Thursday rallied for a second day, with all three major indices ending up more than 1%, as the data showed a second consecutive quarterly contraction in the economy, and that fueled investor speculation that the Federal Reserve may not need to be as aggressive with rate hikes as some had feared. The yield on the benchmark 10-year Treasury note retreated following the data, although it's still inverted compared to the 2-year, while utilities and real estate, both of which tend to rise when yields fall, were the day's best performing S&P 500 sectors. The decline in yields may suggest that markets think the Fed will have to pivot and move rates lower at some point, maybe within the next 12 months, said Mona Mahajan, Senior Investment Strategist at Edwin Jones. It does imply the pace of tightening will become more gradual going forward. Gross domestic product fell at a 0.9% annualized rate after a 1.6% decline in the first 3 months of the year, according to the Commerce Department's preliminary estimate. Now, that, of course, may change later, by the way, because the preliminary estimates do tend to wobble around. Personal consumption, the biggest part of the economy, rose at a 1% pace. That's a deceleration from the prior period. The more important point is that the economy has quickly lost steam in the face of 4-decade-high inflation, rapidly raising borrowing costs, and a general tightening in financial conditions, said Sal Gattaori, senior economist at BMO Capital Markets. The economy is highly vulnerable to slipping into a recession. So this report will add to political headaches for President Joe Biden and complicate the Fed's calculus over how aggressively to raise interest rates. But of course, there was a little bit of pre-positioning ahead of this number, because the president and his team were out earlier saying, well, this doesn't mean that we're in a recession, it's just a technical thing at the moment, and they'll decide later whether there's a real recession or not. In addition to the slowdown in household spending, the report also showed declines in business investment, government outlays, and housing. And inventories also weighed on GDP, while a narrow trade deficit added to the figure. A key gauge of underlying demand that strips out the trade and inventory components, inflation-adjusted final sales to domestic purchasers, fell at a 0.3% pace in the second quarter, compared with a 2% gain in the prior quarter. The report illustrates how inflation has undercut Americans' purchasing power, and tighter Fed monetary policy has weakened interest rate-sensitive sectors such as housing. That is likely to throw fuel on an already heated debate about if or when the US enters a recession. While the common rule of thumb for recessions is 2 consecutive quarterly declines in GDP, the official determination of ends and beginnings of business cycles is made by a group of academics at the National Bureau of Economic Research. The contraction in second quarter GDP significantly raises the risk that the economy will fall into recession by the year end. Lagging momentum leaves the economy vulnerable to further adverse shocks, such as a potential energy crisis in Europe or intensified supply strains in the second half of the year. The median projection in a Bloomberg survey of economists called for a 0.4% gain in GDP and a 1.2% rise in consumer spending. 2-year Treasury yields tumbled after the report potentially reduced further chances of further aggressive rate Fed increases, while the S&P 500 opened higher and the dollar fell. Retailers like Walmart and Target have slashed their profit forecasts, and a slew of tech commodities, including Spotify, have announced plans in recent weeks to cut workers. Others like Apple and Microsoft are slowing hiring. Broader weakness in the labour market that's shown any limited signs of cooling may remove a key source of support for the economy and help shape the course of monetary policy later in the year. We think it's necessary to have growth slow down, Fed Chair Jerome Powell said at a news conference on Wednesday after that 75 basis point hike in interest rates. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. And we also think that there will be, in all likelihood, some softening in labour market conditions, Powell said. Now, according to a separate report on Thursday, applications for unemployment benefits last week were higher than forecast. And the GDP data shows services spending accelerated to 4.1% annualised, while outlays on goods shrank 4.4%. And inflation-adjusted spending data for June will be released on Friday, and that'll be important, of course. Americans are facing higher prices for virtually everything from gas to food to rent, and wages have increased but not fast enough to keep pace with inflation, driving consumer sentiment to multi-year lows. The Fed's determined to limit inflationary pressures, some of which are due to factors outside of their control, like Russia's war on Ukraine. Powell said that while more rate increases are likely, the size of those moves will be data dependent. Currently, the labour market is extremely tight, and inflation is much too high, he said. Last quarter, inflation-adjusted business investment eased 0.1%, reflecting declines in both spending on structures and equipment and outlays on intellectual property products, though rose solidly. Residential investment plunged at 14% annualised. That's the largest decline since the start of the pandemic, and reflective of how high borrowing costs, along with rapid inflation, have squeezed the housing market. Sales have been falling for months, and builders are increasingly downbeat about future demand. The increasing levels of food and fuel inflation are affecting how customers spend. And while we've made good progress clearing hardline categories, apparel in Walmart US is requiring more markdown dollars, Walmart CEO said. The report showed trade added 1.43 percentage points to the percentage change in GDP, while the change in inventories subtracted 2 percentage points. The personal consumption expenditures price index, an inflation measure followed by Fed officials, grew and analysed 7.1% for a second quarter. And stripping out food and energy, the index rose 4.4% after rising 5.2%. And monthly PCE price data will also be released tomorrow. The US dollar, the currency that powers global trade, is on a tear that has few parallels in modern history. Its ascent is the result primarily of the Federal Reserve's aggressive rate hiking. It raised by another 75 basis points, as we discussed, and has left a trail of devastation, driving up the cost of food imports and deepening poverty across much of the world, and fueling a debt default and toppling a government in Sri Lanka, and heaping losses on stock and bond investors in financial capitals everywhere. The greenback now stands at an all-time high, according to some gauges, up 15% against a basket of currencies since mid-2021. And with the Fed determined to keep driving rates up to quell inflation, even if it means sinking the US and global economies into recession, there's little that most long-time currency watchers see to break the dollar's climb. In addition, the growth forecast for second quarter earnings has risen this week as more S&P 500 companies reported results and beat analyst expectations. Among them, Ford Motor jumped 6.1% after it reported a better-than-expected quarterly net income. And after the closing bell, Amazon shares shot up more than 12% as the online retailer reported quarterly sales that beat Wall Street estimates. Amazon.com ended the regular session up 1.1%. Shares in Apple were up more than 3% after hours following the company's quarterly report and upbeat forecasts, and the S&P 500 E-mini futures was up 2%. So the question is, are we on the cusp of a recession in the US? Well, some investors said it may deter the Fed from continuing to aggressively increase rates as it battles high inflation. So the Dow Jones Industrial Average rose 1.03% to 32,529. The S&P 500 gained 1.21% to 4,072, and the Nasdaq added 1.08% to 12,162. In fact, the Nasdaq registers its biggest two-day percentage gain since May the 27th. Stocks had rallied in the previous session when the Fed raised rates, and comments by Fed Chairman Jerome Powell eased some worries about the pace of future rate hikes. More investors are getting in now because they think at least there's not going to be any big surprises over the balance of the summer as far as rates are concerned, said Alex Lance, president of Allen Lance and Associates. The Fed on Wednesday raised the benchmark overnight rate by 0.75 percentage point, and the move followed a 75 basis point hike last month and smaller moves in May and March in an effort by the US central bank to tamp down soaring inflation. Investors have expressed concerns that inflation and aggressive Fed rate hikes could at some point tip the economy into recession. Among declining stocks, Facebook and Instagram payment meta platforms fell 5.2% after it posted its first ever quarterly drop in revenue. And one more point, the US dollar has been very strong. In fact, it has been at an all-time high. It's in fact a bit reminiscent of the Fed's Paul Volcker-led anti-inflation campaign in the early 1980s, which is why chatter is now growing about the possibility of a version of the Plaza Accord. That was the agreement that international policymakers cut to artificially rein in the dollar back then. A similar deal may look like a long shot right now, but with some market metrics suggesting the dollar could easily climb the same amount again, and those gains would convulse the global financial system and trigger all sorts of additional pain, it's likely only a matter of time before talk heats up. There is no kryptonite to blow up the dollar's strength immediately, with the Eurozone hampered by the war in Ukraine and China's growth uncertain, said Vishnu Vaharathan, head of economics and strategy at Mizo Bank in Singapore. There is simply no alternative to the dollar, no matter where you look, and it's pummeling everything else as a result: economies, other currencies, corporate earnings. The US currency's rapid ascent is being felt in daily life around the world because it's the lubricant for global commerce. Roughly 40% of the $28.5 trillion in annual global trade is priced in greenbacks. Its relentless rise risks creating a self-sustaining doom loop. You have recession concerns leading to dollar strength, and then tightening financial conditions leading to more recession concerns, said Joey Chu, strategist at HSBC Holdings in Hong Kong. There's no immediate solution around this. Demand for the dollar has been hot for the same simple reason. When global markets go crazy, investors look for a safe haven. And as the Bank of International Settlements put it, that security is fulfilled now primarily by the US dollar. The size and strength of the US economy remains unparalleled. Treasuries are still one of the safest ways to store money, and the dollar makes up the lion's share of foreign exchange reserves. Some of the top dollar gauges reveal its capacity to rise further. While the Bloomberg Dollar Spot Index hit a record this month, it's only measured from the end of 2004. The narrower ICE US dollar index, its performance against developed peers, is still well below levels seen in the 1980s. And it could take a 54% rally to get back to its peak in 1985. That was the year of the Plaza Accord. Yet circumstances are different this time, said Brendan McKenna, strategist at Wells Fargo Securities in New York. The dollar strength is not as pronounced, at least not yet, and the Fed should cut rates at some point next year when the economy cools, easing pressure on the greenback. Coordinated action to devalue the dollar and support G10 currencies is probably not as much of a priority at this point, he said. Even so, many of those big economies' currencies are suffering, and in addition to the euro slump, the Japanese yen has plunged to a 24-year low as investors flock to higher yields. For many emerging markets, though, the damage has been made even worse. The Indian rupee, the Chilean peseto, and the Sri Lankan rupee have touched record lows this year, despite efforts by some central banks to try to slow the fall. Hong Kong's monetary authority has bought local dollars at a record pace to defend the city's currency peg, while Chile's central bank began a $25 billion intervention after the peso sank more than 20% in 5 weeks. It's not going to work, said Lusa Paelu, strategist at Pictet Asset Management that oversees $284 billion. This rise in inflation, the dollar, are generation-defining events, and it's not something that central banks in emerging markets can do much about. A strong dollar boosts profits for oil producers and exporters of raw materials, as well as international companies such as Toyota that book a large chunk of their earnings in the US. It's also a blessing for American tourists. Of course, It helps having a stronger currency because that stretches the budget even further. Tech behemoths that repatriated part of their global earnings back to the US have taken a hit. Microsoft said the dollar was eating away at its profits, while IBM, which gives Microsoft its first big break back during the last major bout of inflation in the 1980s, blamed the strong dollar for perpetuating a cash flow squeeze. For anyone looking to challenge the greenback supremacy right now, Wall Street has a message: don't bother. A survey of fund managers from Bank of America showed bullish positions on the dollar have surged to their highest level in 7 years. Only when investors are prepared to embrace high-risk assets again do we expect the dollar to turn, and this may not happen until the market is convinced that the dollar has changed course, said Jane Foley, head of foreign exchange at Rubber Bank. There have been bouts of dollar strength before, such as in 2016 and 2018, when the Fed sought to tighten policy. But with the latest data indicating US inflation is at a 4-decade high, there's less wriggle room for the Fed. Indeed, Fed Chair Jerome Powell and Treasury Secretary Janet Yellen has barely remarked. Against this landscape of soaring prices, a hawkish Fed, and the risk of global recession, the dollar smiles. That's according to a widely adopted idea coined by former Morgan Stanley currency guru Stephen Gem. The theory is that currency rises at the two extremes, when the economy is either in a deep slump or growing strongly, and weakens in the middle during periods of moderate growth. Boston-based Garrett Melson of Naxos Investment Managers thinks the greenback's grin this time may be a little darker. Macro forces this year have really seen the dollar smile revert back to the 2010 regime, which was more of a vicious cycle than a dollar smile. Melson, whose firm oversees over $1.3 trillion, wrote in a note, US growth is relatively more robust, leading to dollar demand, which pressurizes the dollar economy, triggering demand for dollars and US assets as a haven, and around we go. So what could break the cycle? Well, investors from Singapore to New York are theorizing about catalysts such as a slowdown, clarity on when the Fed will stop hiking rates, or a material revival in China's economic growth. But it isn't clear when any of those will happen. The US Consumer Price Index climbed to a new generational high of 9.1% in June, and the Fed hasn't hiked rates this quickly since the mid-1990s. Since then, the world economy has changed dramatically. For 3 decades, China's manufacturing ascent kept a lid on the price of millions of manufactured products, even as raw material costs rose. As the Asian nation's supply of cheap labor and capital finally began to dry up, price pressures began to build again. Then came the trade war with the US and the pandemic and Putin's invasion of Ukraine, throwing a finely balanced global trade system into disarray and causing energy prices to soar. With the world's second biggest economy still clinging to its COVID-0 policy, even at the cost of slower growth, a return to normal seems distant. With so many uncertainties, central banks from Australia to Canada have little choice but to follow the US and raise borrowing costs to combat inflation. Expectations of fresh rate hikes are being revised higher by the week. And without more clarity on when the cycle may end, few investors anywhere are willing to bet against the greenback yet. Even if it's at a historic high, it still does not mean everyone is going to take off their position, said HSBC's Chu. We don't think there is a turnaround at this point. So you can see here the critical pressures now in play. On one hand, trying to beat inflation. On the other hand, trying to deal with recession. And meantime, the massively strong US dollar is creating huge issues in emerging markets and elsewhere. There are so many strains and stresses here in the global economy that it's very hard to see other than more turmoil ahead. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.